Welcome back everyone to the Audacious Money Witch channel where we talk about investing and trading stocks, bonds, and crypto assets around the world. Like many of you, I am a shareholder of TTWO stock. I can't wait to play Grand Theft Auto 6. With Grand Theft Auto 6 coming out next year, why is TTWO not moving higher? Instead, it's making lower highs. What is going on? Why does the debt keep increasing? What is the real problem with this business? I am here to explain the real problem with TTWO stock right now. Despite owning some of the world's most beloved and profitable video game titles, with Grand Theft Auto and Red Dead Redemption series, Take-Two Interactive Software, one of the leading pure-play video gaming holding companies in the world, recently took a big goodwill impairment on its Zynga acquisition due to the uncertainty of the mobile gaming and overpaying for it. Grand Theft Auto 6, a proven business model, made even greater. The video game business model originated from developing, marketing, and physically distributing their game for a retail price of around $60 to $90. In 2008 to 2013, Take-Two, with its subsidiary Rockstar Games, released Grand Theft Auto 4 and Red Dead Redemption 1. Even though both games generated a staggering $3 billion in revenue with a cost of only $200 million in development and marketing, Take-Two still struggled to make a profit, partly due to the recession in the late 2000s. Even with these blockbuster games, Take-Two lost $149 million in earnings and $228 million in free cash flow from 2008 to 2013. The release of Grand Theft Auto 5 and Red Dead Redemption 2 turned things around, netting them around $2 billion in profit and $4.23 billion in free cash flow. So what changed during these periods, resulting in a loss of $150 million from 2008 to 2013 to a profit of around $2 billion from 2013 to 2022? The answer is franchise games and microtransactions. The rising cost of making AAA games is an ongoing concern for the video gaming industry. Grand Theft Auto 4 in 2008 cost Rockstar $100 million to make. This increased to $300 million for Grand Theft Auto 5, and now analysts are estimating that it will cost Rockstar $2 billion to develop and market Grand Theft Auto 6. Development and marketing costs around 20% per year. To offset this rising cost, the industry relies more than ever on its games called franchise titles. These games have the capability for the video game companies to immediately recoup their development cost in the first couple of weeks or months after release. Grand Theft Auto 5 was able to recoup its investment of $300 million in the first week of release with $1.15 billion in sales. The cash flow from these blockbuster games allows gaming companies such as Take-Two to transfer developers to new projects while retaining an adequate team for just released games to focus on extending its lifetime value through DLC or expansions, which requires much less resources to sustain while being profitable. Furthermore, these franchise games, which are similar to previous iterations, allow video game companies to streamline their development process and focus their resources on new features that will differentiate the latest game from the old ones. In addition, microtransactions immensely benefited Take-Two through upselling. In PC console games, customers or gamers usually dedicate their whole attention to playing the game through gameplay loops. They build this connection with their characters, desiring their character to be exclusive or different compared to the general players or non-paying ones. This allows companies to cater to this demand by releasing exclusive skins or making it so hard for players to get that in-game item by playing that it logically makes sense to buy the currency with real money to purchase that item. Since 2018, Take-Two's consistent earnings and free cash flow growth have correlated with its recurrent consumer spending growth. Additionally, having a franchise title in a gaming company's portfolio provides a significant competitive advantage because the rising cost of developing video games will act as a barrier to entry that prevents smaller developers from competing. A franchise title's reliable revenue provides the investments needed to develop future games. Additionally, the revenue from their franchise titles can be used to purchase these small players, finance them, and publish their games instead. This is prevalent today as the industry is consolidating into a few big pure play gaming holding companies such as Electronic Arts and Take-Two, or big techs such as Microsoft and Amazon. However, this is not without risk, since this model requires Take-Two to make it right and ensure that its customers well received the game they are making. Otherwise, they will be in a precarious position where they are so invested in this one game that they risk putting their next game and even the company itself into peril. With a net debt of $2.7 billion, a much bigger company, and a different cost structure due to the inclusive of Zynga, they need to make sure Grand Theft Auto 6 delivers. Zynga acquisition, a conflicting synergy but has potential. One of Take-Two's rationale for acquiring Zynga is the high growth potential of the mobile market. Take-Two's purchase of Zynga allows it to participate in the largest part of the video game TAM and leverage Zynga's existing distribution, marketing, and go-to-market capabilities to bridge its existing PC and console video game intellectual properties into mobile. While this makes sense, I see some problems with this strategy. Despite mobile gaming being the highest growth segment in the total addressable market for video games, a crucial difference between PC console and mobile gaming is the barriers to entry. As mentioned earlier, the rising cost of developing AAA games is a competitive advantage for large video game companies like Take-Two Interactive and protecting them from small indie developers due to their lack of adequate capital to develop a game that will compete with AAA games. In contrast, the mobile gaming market operates differently, especially in the casual and hyper-casual segments. Mobile players often play between breaks or waiting times, leading developers to create simple, quick-to-play, and engaging games to encourage frequent returns. This simple gameplay allows small gaming companies and even solo developers to compete effectively against big companies through creativity alone. As a result, the competitive advantage that Take-Two enjoys in the PC and console market, driven by huge development costs and complex gameplay, does not effectively translate into the mobile market. Let's examine Zynga's financial performance before the merger to understand better how different these markets are. To gain attention in this crowded market, especially in the casual and hyper-casual mobile gaming segment where Zynga is participating, the company is spending significant revenue on sales and marketing. Though the gross margin is attractive due to the intense competition, they need to spend a lot on marketing to attract players to try their games. They hope the potential recurring revenue from these customers will offset acquisition costs, which was made harder by Apple and Android's recent implementation of IDFA, making acquisition costs more expensive. Now let's compare it to Take-Two's sales and marketing and R&D spending. Due to the brand recognition of their main titles, such as Red Dead Redemption, NBA 2K, and Grand Theft Auto, their lengthy lifetime value through its continued support through DLC and expansions, and the high barriers to entry due to the high capital required to develop AAA games. They can afford to spend significantly lower marketing compared to Zynga. Take-Two also has lowered R&D expenses since they don't need to release as many titles at a time as mobile companies to sustain their growth. In contrast, Zynga needs to develop games consistently since the market they are participating in has historically had low hit rates, putting them in an endless loop of periods of elevated R&D spending and eventually higher marketing spending to advertise these new games. Take-Two is just starting to realize these realities, and it recently impaired a significant amount of Zynga's goodwill. Zynga contributes almost 50% of revenue to Take-Two's top line, with a significant portion coming from recurring consumer spending. The question now is how Zynga will improve its profitability given the many unknowns in this area. It is one of the avenues I believe is currently not priced into Take-Two's current valuation. I'm still optimistic about Take-Two's prospect moving forward, with Grand Theft Auto 6 releasing in fall 2025, and I will continue buying the dip when this baby falls.